Well, good evening, ladies and gentlemen. A very warm welcome to the StashAway 2025 Market Outlook, an exclusive event that brought to you by StashAway Hong Kong. We have over 300 signups online and on-site today. So first, let me say hello to the audience online first. Hi. Okay. So thank you so much for your enthusiasm and support. I am Casey Deng, a wealth advisor here in StashAway, and it's my pleasure to be your host for this evening. When you first see the theme of the StashAway Outlook this year, Doge, what do you think of? Exactly. Some people think it's the Dogecoin. We want to use it to reflect the crypto enthusiasm that you may have in the market. And second, it also stands for the Department of Government Efficiency, a new commission that is proposed by the Trump administration. But last but not least, it stands for decoding the opportunities in global economy. So tonight, we are very honored to have a very strong lineup today. First, we'll have Tai Hui, Chief Market Strategy Asia Pacific of J.P. Morgan Asset Management. And we also have Thomas Taw, Head of APAC Investment Strategy of BlackRock. And also our very own Stephanie Leung, Chief Investment Officer of StashAway, and Ronald Yim, General Manager of StashAway Hong Kong. This is our agenda tonight. So first, you will learn more about StashAway if you're not a client yet, and also our 2025 Market Outlook, views from different asset houses, and followed by a networking session. First, I would like to invite everyone to scan this QR code to ask us any questions that you may have during the event, and the most asked questions will be addressed during the Q&A session. Okay, you will also have the chance to scan this QR code at a later stage during the Q&A session. So without further ado, may I invite Ronald Yim, General Manager of StashAway Hong Kong, to give us a brief introduction of StashAway. Ronald, please.
Hi everyone, good evening. My name is Ronald. I'm the general manager here, so I manage the overall BD, marketing, and all the operation here. So it's very glad to have more than 300 people signing up for the event, online and offline. I'm very glad to see everyone here. So for people, before we get into the market outlook, please allow me several minutes to quickly introduce StashAway. For people who are not familiar with us, we're a digital investment platform that provides personalized and curated investment portfolio to individual investors across Hong Kong. By leveraging technologies, we make investment simpler, more intelligent, and more cost-efficient. And in Hong Kong, we're very fortunate to have Mr. John Zhang, former Financial Secretary of Hong Kong, to be our senior advisors. So when our founder founded StashAway back in 2016, right? Wealth management, investment could be sometimes very complicated, very non-personalized, and quite expensive because there are so many people along the value chain. When we founded the company, we want to make investment simpler, intelligent, and more cost-efficient. So we founded back in Singapore in 2016, and then we expanded to Malaysia in 2018, we expanded to Hong Kong, Dubai, Thailand in 2021, and today we're the only platform that are fully licensed and fully operating across 5 APAC and Middle East markets. We're helping more than 100,000 clients to manage billions of assets for our clients. Fortunately, we're backed by very strong institutional investors, including Sequoia, Fidelity, SquarePack, Humatalink, etc. As the asset managers, as a wealth platform, we're definitely fully licensed. We got the number 149 license from SFC. And also, we're fully licensed across all the markets that we operate. Also, we're very honored to get numerous awards and media presence attentions. For example, we're named by CNBC as the top fintech in both 2023 and 2024. We're named as a technology pioneer in 2020. So going back, right, as John, right? We want to be our client personal financial secretary. But what it means, right? Number one, being real simple, right? We have a very, very good app. You can like create an account, create a portfolio, make deposits simply less than 10 minutes. You can do everything yourself in the app. But at the same time, we adopt a digital-first approach. If you have any kind of questions, you want financial planning, we have a non-commission-based team to help you along the journey. Second thing is intelligence, right? We use a lot of data. Stephanie will definitely mention more. We use a lot of data, we have a proprietary algorithm to support our investment decisions. A lot of retail clients focus on like security selection, right? But actually the high net worth individuals, the institutionals, actually they use asset allocation instead of security selection to manage their money. We want to bring this concept to individual investor, regardless of wealth level. So we provide a personalized asset allocation based on your risk appetite. Number three, you can start with any amount. There's no minimums, no lockup. Number four, right? We are very cost efficient, right? Our management fee is as low as 0.2%, right? So we give back all the fee to our clients and to improve the return. Why we can be so cheap or cost efficient? Because we use a lot of technologies. We use a lot of technology to streamline the process, to make the process much more automated. Lastly, secure, right? We're SFC licensed. We also separate our own money with our client monies. We have a custodian account, so a fully secure platform to use. Many people ask, right, how are you different from brokerage, right? Like get all back, right? Number one, instead of a supermarket, we provide a very, very curated approach in what product we give to our client. Secondly, right, like we have our own investment team, we have a strategic partner to help us to together manage the portfolio. Number three, we actually say, if you go to a bank, you probably get a commission-based relationship managers. If you go to like a brokerage app, probably you need to do your own. There's no advice, to be honest, right? You need to use your own knowledge. Here, not only we use automated advice, we will also have like a non-commission-based RM team to support you along your investment journey. Lastly, it's about fee, right? Where a fee is much lower than typical banks, pirate banks, or so in terms of like asset management, right? So, and we give back all to our client. Lastly, we have a very simple yet comprehensive portfolio for our client to meet all of their needs. Our core product is actually the global investing powered by StashAway. It's a global multi-asset allocation model. We have 12 different risk appetite, and then we actually continuously find the best allocation based on the regime for our client using our algorithm. We have also served another version powered by BlackRock. We have the model portfolio available for our platform. Apart from the global, like the core portfolio, the global multi-asset allocations, we also have cash management offering. We also have thematic offering, and for professional investor, we also offer institutional grade private funds at much lower cost and much lower minimum than typical private banks. We manage a lot of product together with our partners, including BlackRock, J.P. Morgan today. We have also like State Street, Vanguard, Invesco, etc. So it's a very short summary of StashAway. Our team is actually here today, so please feel free to ask any question in the Q&A or stay behind for networking. I'll pass it to Pacey.
Thank you, Ronald. Okay, so before we share our market outlook, I would like to understand the thoughts of our audience here tonight. This is the question. Which asset class are you the most bullish on in 2025? Equities, bonds, real estate, commodities, or crypto? Scan the QR code and let me know your thoughts. Okay, let's see. Well, seems the audience here are quite traditional. I may be wrong. Okay, seems like equity is still the winner. Other thoughts from the audience? Okay, I have 5 more seconds. If you haven't voted yet, please. Okay, no one. Oh no, crypto is actually the winner. On the top, sorry, like from my end, it's a little bit difficult to see. So 65% of the audience think crypto would be the winner this year instead of equity. Stephanie, is it the same as what you would have imagined? Okay, well, anyway, so seems the audience here, like you attend the event today, you think of the Dogecoin, and you're super bullish on crypto. So, without further ado, may I now invite Stephanie Leung, a CIO of StashAway, to share the recap of 2024 and our market outlook for 2025. Stephanie, please.
Right, okay. Well, I guess first of all, thank you so much everyone for joining us tonight. I know there's a lot of different events during this time of the year. So the fact that you've picked to come to join us at StashAway together with our friends from BlackRock and J.P. I mean, that speaks a lot, and thank you so much for that. I'd like to wish you all a very, very happy 2025. And of course, since Chinese New Year is just around the corner, 恭喜發財 to everyone. And with that, let me just start my short presentation, followed by our panel discussion. So before we go into what's in the box for us for 2025, I thought it would be useful for us to just have a quick review of 2024. And obviously, a lot of things happened in the last 12 months, but I'd like to just summarize the top 3 surprises that, at least to me, was actually quite unexpected. So what are these top 3 surprises? Number 1, federal fund rates. So the Fed actually cut 100 basis points in 2024 towards the end. I mean, that surprised a lot of people, right? Most people would have thought that the Fed may cut, but it could be 25 or 50 basis points. The Fed actually ended up cutting a lot more. But to me, that was actually not the biggest surprise. To me, the biggest surprise was that if you look at US bond yields, if you look at longer-term government bond yields, they actually went up, even though the Fed cut interest rates. And that is something that's quite unusual. So for example, if you look at this chart, you can see 2 lines. The gold line is the the Fed's interest rate. So as you can see on the right-hand side, interest rate did come down. The blue line is actually the yield on the 10-year Treasury. And you can see that in the last cycle, during the 2019 interest rate cut, actually yields on the long-term Treasury did come down. However, in 2024, that was not the case. Actually, the yield on the 10-year Treasury went up. So there's many reasons to that, and I mean we'll talk about that, but just kind of keep that thought in mind as we go through the presentation. Secondly, there was a lot of concerns about recession. I know that sounds very, very distant, and probably a lot of people wouldn't remember the word recession anymore, but just 9 months ago, I mean, people were actually worried about a recession, if you remember. And the surprising thing was, of course, number 1, recession didn't happen. I mean, to us, that was not a surprise, because for a very, very long time, or at least in the last 12 months, all our indicators told us that we would not have a recession. So we've had the view that recession risk was actually overblown. What surprised me, or what surprised us, was that despite no recession, gold was actually the best performing asset among the 4 major asset classes that we track or in our portfolios. So if you look at this chart, gold is the line in gold for obvious reasons, and you also have equities, which is in blue. So both gold and equity returned quite positively. However, at the end of the year, gold actually significantly outperformed global equities. So this was actually quite surprising to me, because I think in April, we actually, when we did our last adjustments to our portfolio, we actually included gold in our portfolio, but I wouldn't have expected gold to have performed so well throughout the year. And at the very bottom is actually the only asset class that had negative return, that was actually bonds. So it's just another representation of the slide before this, which is that, I mean, when bond yields go up, I mean, prices come down. So in the middle, that was cash. A lot of us have a lot of cash in the bank. I mean, this year, cash would have returned, or last year, cash actually returned slightly more than 5%. So still decent, but compared to gold and equities, investors would have ended up better actually investing in those asset classes. So lastly, bringing things back to home, or bringing things back closer, Chinese equities. So I think at the beginning of the year, a lot of people, or foreign investors mostly, were saying Chinese equities were actually uninvestable. And we've held a market weight view on China, meaning that we thought, valuations were actually quite low, but then still there's a lot of uncertainty in the economy. Therefore, we didn't go overweight, but we thought it was prudent to just stay market weight. And towards the end of the year, when we kind of tally up the scorecard for different countries, actually China didn't do too badly. And indeed, if you look at this chart, you can see the different lines actually represent different equity markets. On the top was 25% return for US equities. We all know that US equities is the best performing market. However, coming in a close second, the red line, that was actually Chinese equities. So Chinese equities actually returned almost 20% last year. It was actually a bull market for Chinese equities. It actually didn't feel that way. Why? It still felt like a bear market because I think number one, Chinese equities have gone through a very significant drawdown in the past 3 years. So last year was a reversal of that. Secondly, if you look at how Chinese equities have performed throughout the year, the rally was actually very, very much concentrated just in 2 months. Basically, it was in May and in September. So, these are kind of policy-driven rallies. So if you have missed those 2 months, you basically wouldn't be able to capture the 20% upside for Chinese equities at all. So I think, the strength of the Chinese equity market surprised a lot of people, including ourselves, but also the fact that it was a bull market, but it felt like a bear market. I think it was also like a surprise. So with that, actually, StashAway, as Ronald has mentioned, we provide globally diversified multi-asset asset allocation portfolios to our clients. And I'm glad to report that we've done fairly well in the past 3 years throughout the cycle. So on the right, you can see that equity markets and also our portfolios on average have had a drawdown in 2022, given that most of the asset classes were negative that year. We were outperforming our same risk benchmarks on average, given smaller drawdowns during the 2022 bear market. And since then, markets have recovered, and we were able to actually continue to outperform our same risk benchmarks. And indeed, if you look at the last 2 years, it has been a pretty good year for all our portfolios. So, for example, in 2023, our portfolios returned 6% to 20%, and in 2024, they returned about 2.4% to 15.7%. This is despite, on the lower risk side, bonds actually had negative returns. So where did we get the alpha? We got the alpha from over-allocating to cash as well as gold. So that was a quick recap of 2024. Now, what's in store for us in 2025 and beyond? And me and my team at StashAway, we spent a lot of time thinking about what are the themes that would work not just for the next 3 months, but for the next 3 years. And here is, what we kind of put out after a lot of thought. Fat. And that's why we've titled Fat is a New Normal, because I think fat actually encapsulates 3 very, very, very important drivers of future investment returns that we should all be aware of. The first one is fiscal policy. Second one is artificial intelligence. And the last one, of course, our favorite, Trump. So let me just go into a bit more detail on each one of these themes. On fiscal policy, I think what we're entering is actually a regime shift from monetary stimulus into fiscal stimulus. So if you roll back to the GFC, the Great Financial Crisis, since the Great Financial Crisis, a lot of the investment returns or kind of markets ups and downs are were driven by central bank actions. Central banks actually inject liquidity, they take out liquidity, and that induces a lot of economic cycle. We think that actually that is shifting to an era of fiscal policy. So not just Trump, the US, but also other countries. But let's start with the US. So this is a chart that shows you the calculation of US debt as a percentage of GDP. So meaning that, okay, how indebted would the US be? Today, that ratio is about 100%, It seems high, but I mean, ranked among other governments, for example, Japan or even China, it's decent. It's not too bad. However, under the current Trump policies, that ratio is expected to rise quite significantly. So if you look at the on the right-hand side, in about 20 or 30 years, I mean, this ratio is going to rise from 100% to anywhere between 130% to 160%. And remember, US is actually a very, very important economy because of its reserve currency status. And also, if you think about the US Treasury, yield on the US Treasury is actually called the risk-free rate because it directly impacts the asset pricing of a lot of other assets. So remember, like when I said in the first surprise that, I mean, even if the Fed had cut interest rates, US Treasury yields have gone up. I think partly because the market is starting to price in the fact that US government debt, US is going to issue a lot more debt. So think about it in simple terms. If somebody is trying to borrow money, but they are getting more and more in debt, of course, you lend that person money, you're going to want higher returns. So this is something that we need to keep in mind for the next, not just for the next year, but also I think for the next decade. And I mentioned it's not just a US phenomenon. This is actually a global phenomenon. I think over the past few weeks, we've heard I guess news from France and Germany, for example. There's a lot more noise about, oh, government needs to spend more to boost the economy. So this is a chart that shows you that when we did a comparison of the government fiscal situation pre-COVID versus post-COVID, we found that actually most government are getting more in debt. So I guess in here, the darker the red box, the kind of more indebted governments get. And on the top, you can see actually China, the second biggest global economy. So next one is so AI, artificial intelligence. I'm sure like all of us are bombarded with AI every day now. But I think it is important to kind of identify some different phases of AI development. We can talk about AI all night, which unfortunately we don't have time. But I mean, I think if you look at kind of what has been happening in the last 2-3 years, a lot of that was actually focused on generative AI, so LLMs, models, etc. And a lot of that was actually much more experimental. I think this year we're going to see a shift into other kind of AI categories, and most importantly, if you look on the right, on the left-hand side, there is autonomous agents, and then on the top there is augmented software engineering. And also the other important shift is that corporates are starting to adopt AI. And if you look at this chart, this basically shows you the survey to CEOs. And in the last 12 months, if you ask CEOs how many of them have actually adopted AI in their corporation, 51% of them would have told you, no, we haven't done it. But if you ask them the next 12 months, 58% or close to 6% says they will adopt it. And if you look at, I guess, next 3 years, I mean, that goes up to 70%. So that means a lot more companies are going to get much more efficient and also grow their revenues using AI technologies. Now, we've had a big rally in Reg 7, and of course, everybody knows NVIDIA's story. I think starting this year, we will see kind of a wider spread benefits of AI impacting company margins. So, for example, software companies, even, for example, industrial companies, auto companies, I mean, we are seeing these companies already reaping the benefit of these AI agents and also autonomous engineering. So that's something to pay attention to. Lastly, Trump. And I think we've shown this slide before, and these are kind of all the major pillars of the Trump policy. I think what we need to focus on as investors are the top two, tax cuts, deregulation. I mean, these two are obviously beneficial for markets because they boost growth. At the same time, I mean, they also kind of, because growth is better, they boost inflation somewhat. I think on the risk side, a lot of useful on tariffs, of course, but also I think one area that is even a bigger risk is actually immigration. Because immigration is actually negative for growth, or kind of stricter labor policies is negative growth. but it could add much more to inflation pressure. The other reason why I think immigration is actually should warrant much more attention than trade or tariff is because of what the US voters actually said. So this is a survey asking US voters what they would expect President Trump to focus on in the first 100 days. Now, on the top are the two major areas. US voters actually have a lot of concern on inflation and immigration. Look at where trade is. Actually, trade ranks very, very low. So actually, I think US voters are a lot more relaxed about tariffs and trade. And that's why I think in the past few days, we've had some news flow about, oh yes, I mean, Trump is going to implement some form of tariff, but it's going to come in like phases or a slower pace than what the market has feared. But I think immigration is actually the key risk here. Having said all that, so given all that, I mean, where do we stand? Like, where do we think asset allocators should put their money? And here I refer back to, again, our investment framework that we've been running for the last 8 years. And this framework some of our long-term investors may be quite familiar. It's called ERAA, Economic Regime Asset Allocation Model. So basically what it does, very, very quickly, is that it takes a lot of real-time economic data input to identify where we are in the macroeconomic cycle. And based on that economic cycle, we actually create the portfolios that are best optimized in terms of risk and return. So at a very top level, we have 4 different regimes. And these regimes are classified by positive versus negative growth or high and low inflation. And on the left-hand side, you can see that there's good times, which is low inflation, positive growth. And as the name suggests, I mean, that is actually the best quadrant to be in for risky assets. Today, we're not there. We are actually in inflationary growth, whereby, I mean, growth is actually positive, but inflation still remains quite high. And we've actually been in this regime since April 2024. Although, I mean, inflation is still a concern, if we are kind of on the top quadrants, we would actually have a more aggressive tilt to our portfolios, meaning that we overweight equities, we are kind of underweight gold, underweight bond, and we have some gold as balancing assets. I mean, this has worked very well for us in the last kind of 2-3 years. And given like everything that we've said, we think that we may remain in inflationary regime for the next few months, at least, if not like longer. And of course, what I said is what we think would happen. Things actually always turn out not as expected. But what we have is actually a system that monitors data on a real time. So if, I mean, Stephanie's prediction is wrong, then our system would tell us in real time, and we will be able to adjust our client portfolios very, very quickly. With that, that's the end of my presentation. I think we can start the panel.
Thank you, Stephanie. Thank you. So now we have heard about the view of StashAway. Let's jump into the panel discussion to understand the views from different houses. May I invite Tai Hui, Chief Market Strategist, Asia Pacific of J.P. Morgan Asset Management, and Thomas Taw, Head of Asia Pacific Investment Strategy of BlackRock, to join Stephanie together on the stage. Okay, let's get started. So we are very honored to have these brightest minds with us today. So Tai and Thomas, I mean, we know your title, we know the company that you work in, but what we want to know is more about your personal investment philosophy. So could you tell us a little bit more about yourself and what is your personal investment philosophy? Just in very simple.
Yeah. Thank you. Nice to be here, and sorry, I've completely lost my voice. So I want to say thanks for making me look so tanned in this photo, because it's a very nice touch. My personal investing philosophy is that I'm not particularly smart, so I don't try and time the markets. I think, like, generally what I try and do is put some money aside every month and invest in one thing, which I think looks relatively attractive, and that can change month to month, or that can be the same thing for 6 to 12 months. So I think the problem with personal investing is sometimes when you look at things like US equities or AI or whatever, things have run up so much that you might try and time the market or short it or use leverage or whatever, and it just never seems to work out. So invest long term and just kind of buy something new every month. That's kind of my philosophy.
So I started my career as an economist, and I was a terrible investor. As soon as I started to do this job, I think two things. One is we speak a lot about investment discipline and principles. When I stick to them, it tends to work okay. When my emotion takes over, I make decisions that usually when things go wrong. So I think it's come back to what we tell all our clients in terms of discipline and principles, staying invested. Some of the, not best, but some of the better returns usually is where I invest something, I forget about it for a couple of years and come back. That usually gives me a nice surprise in the end.
Okay. Yeah, I mean, I echo what both Thomas and Tai said. I think one of the tools that I started using when I joined StashAway is actually dollar cost averaging, because StashAway makes it so easy to do. Like previously it was very, very hard, and you always have to, when you don't have like dollar cost averaging, which means like basically you automatically like set yourself a time schedule to put in like a certain amount of money every month. When you don't have that, it's always like kind of your emotions questioning yourself, right? Am I getting in at the right time? Should I wait 2 more days? Is the market correct? And setting up dollar cost averaging actually takes out all that kind of, I guess, doubts and nuances of investing. So I think that was one good habit that I started to have when I joined StashAway. And I encourage, given that this is the new year, a lot of people are actually trying to form new habits. I would encourage everyone just to, try it. I think, I guarantee you actually won't regret doing DCA.
Okay, I hope there will be no echo. Okay, so now, looking back to 2024, the word to best describe the market, I think, is resilient. The economic resilience has supported the equities, especially in the US. So where are we now in the market cycle? Should investors continue to add risks or to be more defensive to de-risk? I know, Stephanie, you have already shared our view earlier, but maybe let me first go to Thomas to share your view.
Well, I think that kind of depends on what you're looking at. So I think generally when you talk about investing from a global perspective, the big question is how overweight US do you want to be? And then when you break it down, that basically means how overweight tech do you want to be? How overweight growth do you want to be? How overweight the mega cap 7 do you want to be? I think 2025 is going to be a year of disparity and granularity. We're already starting to see some rotation into some of the laggards and things like financials, et cetera. And so I would say we are still overweight US equities, but with a relatively low conviction. And so I think the ability to be nimble and granular in your investment approach is going to be really, really important, because the market is not going to be driven by valuation expansion next year. So you need to look for, number one, where is the earnings growth? And number two, where can you be a little bit more defensive by using systematic approach and also getting income?
What about time?
So listening to Stephanie, my concern is I actually share a lot of her thoughts as well. So just to be a little different, I do agree that we are still in a strong growth phase in the US. Even though the Fed may be cutting rates more gradually than expected, this combination of good growth and easing monetary policy typically is good for equities. A bit more challenge for fixed income, especially where the fiscal policy is moving towards. But I think one thing, again, coming back to the question of discipline, is that if you have invested in equities in the past few years and if you have not rebalanced, it means that you're already by default very much overweight equities. So the question then becomes, coming back to your investment objectives and what StashAway recommend in terms of your appropriate asset allocation, are we doing the rebalancing so that you're taking some bit of profit off the equity space and then reallocate into cash or fixed income or gold or whatever else that you want to invest in? So I think that's, to me, it still makes sense to be overweight equities, but having already enjoyed 2 really strong year performance, or should we just take some money off the table and move that to other assets? Just to be a bit more balanced.
I see. So to be like, so that shows our independency, right? We do show different views of different houses. So moving next, what might affect the market is actually the Trump's policy. So the Trump administration 2.0 is starting in a few days. What do you think are the key differences between the Trump 2.0 versus Trump 1.0, and also the Trump versus the Biden administration? Maybe this question I will first pass to Stephanie, because you have shared the impact of the Trump policy, but any differences between the Trump 1.0 and 2.0?
Yeah, I think one obvious difference is the bromance with Elon Musk, which didn't exist in Trump 1.0. So I think that actually injects a different kind of point of view than what Trump 1.0 would have. In the sense that, I mean, of course, you think about Elon Musk and also kind of the guys at Silicon Valley that are rallying around Trump, they are much more concerned about like doing business and also kind of producing or sustaining American growth. And if you think about all the different policies that I put out in the chart, I mentioned, I mean, tariff is one thing that was very much a focus of Trump 1.0. I think just the setup we have right now, that is, of course, a lot of noise or a lot of rhetoric will go into that direction. But in terms of, I guess, what's going to be executed or what's going to be actually put in place, I suspect it's going to be a lot more noise than real action. And I think one thing that's not going to change for sure is that there'll be a lot of, I guess, noise and also a lot of just talks from Trump, especially on Twitter. So, I mean, that's going to keep all of us very, very busy. But I think it's important to differentiate noise versus actual, like, implementable, like, policies.
And Tai, any specific about the Trump 2.0 that you want to add?
Yeah. I think on the economic side, it may not be that different. I mean, obviously, on trade, he's pro-tariff, most beautiful word according to him. On taxes, lower taxes to corporate. Stock market is very much its KPI. Right? But I think where things could be quite different from Trump 1 versus Trump 2 is on the non-economic stuff. Because in his first administration, there was still quite a lot of more experienced administrators in his cabinet. This time round, if you look at his cabinet appointment, especially in defense, intelligence, it's really his own people. It's about loyalty. So I think where things can be quite different may not be where it concerns us as investors, but how US domestic politics could play out over the next 4 years. I think that could be the area where there'll be a bit more obvious differences. Trump versus Biden, frankly, Biden is the set menu in a restaurant. You know exactly what you're going to get. Trump is the omakase where you don't quite know. Some could surprise you on the upside with deregulation. Some are surprised with food poisoning on the downside. So I think the breadth of outcome from Trump 2 could be much wider, again, both positive and negative compared to Biden. Frankly, last 4 years, from the macro policy perspective, it was fairly predictable, but I suspect there will be a lot more question marks, uncertainty, a bit more trial and error in Trump 2.
I see. So just now, our conversations and discussion were focused a lot on policies, but we can never overlook the economic substance. So last year's equity market was driven mainly by the AI boost and especially by the Magnificent Seven. So the development of AI, we know is incredible, but there are always questions about how much further it can go. So this question, I think, is to Thomas. How solid is the fundamental you think is supporting the high valuation of AI-related stocks?
Just very quickly before I answer that question, just on the Trump situation, there's the question of like what's going to happen over the next 4 years in policy, but there's also the question of where are we in terms of the economy versus 2016, and we are in a very different environment. So that doesn't necessarily mean that things will be massively different or not different in terms of what Trump does, but we do have to understand from an asset allocation perspective, valuations are much higher, inflation is higher, growth is lower, etc. So I don't think we're going to have that 2017 Goldilocks environment, which is not to say like we're not bullish, but just to understand that it's slightly different. In terms of the AI situation, I mean, the way that we're kind of seeing things at the moment is AI as a theme is broadly understood, but the workings of it are not really understood in terms of how they will feed down into earnings growth of companies. And what we know is that, yes, there is a lot more usage of it across companies. What we don't know is exactly how that's going to impact growth of earnings for those companies. And I think this year, basically, what we're seeing, or what we think is going to happen, is shifting from a known, which is basically buying semiconductors. That was kind of the proxy trade, because no one really understood like what was going to happen, but we knew you need semiconductors to power this. The shift is now moving into the kind of the infrastructure space, because we know that these companies need a lot more power to actually drive forward these digital innovations, and that's basically going to need to be funded by infrastructure investments. So that can be on the private side, that can be on the public side, but that seems to be like the next phase of where the AI growth is going.
I see. And Tai, do you think the AI growth will spread to other sectors, and any specific sectors that you have in mind, and why?
I think so. I think if you look at even just the financial industry, I'm sure we're all using AI to one way or another. I think that's going to be one area where you will see cost savings and efficiency gains. It may not contribute directly to your top line right now. Other areas include research and development in chemical engineering, in healthcare, biosciences. So I think from that perspective, I completely agree with both Stephanie and Tom that AI, the next stage, is how companies and developers make use of AI. I think the other thing to point out is if you think back to a lot of the technological advances in the past 20, 30, 40 years, what we see today and what we will see in 5 years, I think a lot of the things that we could see in 5 years' time, we cannot imagine right now. The example I often used is Netflix, where now I'm a bit older, so I used the 50K, 6K modem that made the funny noise when you download stuff years ago. And I've calculated that if you use that to download a movie today, it would take about 10 hours. But if you use your phone or your laptop, it takes about 3 minutes right now. So the hardware development needs to, the software development needs to accompany by hardware development. So in that sense, I think over the next 3 to 5 years, you will see huge changes in how AI is being deployed. But at the moment, it's somewhat constrained by the hardware, and that will continue to develop. So I am still very, very optimistic on how this will progress. But some days we will get questions, are we too optimistic? Yes, not every Mac 7 companies will benefit or turn out to be winners. I'm fairly sure some of them will lose in the competition. But overall, the concept of AI as an industry, as a development, I do feel very optimistic about.
I see. Stephanie, anything to add for AI besides the AI agents?
Yeah, I think obviously AI is going to impact a lot of different industries, but also within just tech itself, I think investors and ourselves need to start to differentiate, look at the finer details. So for example, I think last 2 years was a lot about just kind of investing in chips, buying the latest like NVIDIA infrastructure, and also the performance was very, very much driven by just the top companies. And things like software companies, for example, basically didn't benefit that much from AI, and those basically fell outside of investors' kind of interests. But I think this year, if you look at kind of where the fastest advancements are, code generation, for example, has been advancing very, very quickly, and I suspect in the next 6 months, we're going to see big improvements in terms of agents that are able to just do very, very complete coding. What does that mean for software companies? That means that either they can actually save a lot on cost, or they can expand their offering a lot, much more widely. Already, I think you've seen some solutions coming out from like Salesforce, for example, or SAP, etc., that utilizes these sort of kind of very, very new AI generative technologies. So I think those are areas that, it's still tech, but it's actually less sort of expensive or less focused than just the Mac 7.
I see. So now we have talked about the policies of the US. We have talked about the AI sectors that is also largely in the US. So let's shift the focus to China. In our market outlook share just now, we know that China was, in 2024, it was actually a bull market. And now China, they are also taking a more proactive approach in reviving the economy. I want to understand your view, Thomas. What do you think are the opportunities and challenges ahead for the China economy and maybe the China's equity market?
I would say, the way that I look at China is that I do think there is an opportunity there in terms of, particularly on a short-term basis. I don't think that China at the moment, is a fundamentally driven market. And what I mean by that is that in terms of the earnings growth, which there really hasn't been any for over 3 years now, because coming out of COVID, consumption actually decreased, which is very different than the majority of other economies. But on the other side of that, we know that foreign investors have been massively underweight China, maybe because they've been funding in India overweight, but also because it's been very difficult to put an equity risk premium on Chinese equities. So I think the way to invest in China at the moment is, I think basically you need to be neutral, as Stephanie mentioned earlier. I think that's the way to do it. And if you want to go one level deeper, I think you need to be invested in the onshore domestic story as opposed to the offshore story, which is very, very different than the previous bull market rallies that we've seen over the last 20 years, where something happens, you have a spark, right? So in this situation, it was the liquidity provisions that were promised at the end of September. And usually what happens is the ADR names, the H shares, rally significantly because they're the most accessible from a foreign investor perspective, and they generally tend to have short interest, which is quite high. In this situation, the Chinese government regulators, etc., are trying to target consumption, and they will do that by giving liquidity provisions that basically will benefit the domestic consumer stocks. So I think the summary is you need to be at least neutral on Chinese equities at the moment, and if you want to take it one step further, I think it's an ETF beta story, and I think it's in domestic stocks.
I see. So for the Chinese equity, you think that we should take a neutral position. And Tai, the question for you is that many people think that the China equity market now is a very reasonable price level. But the question is where the growth, like future growth, will come from. What kind of measure do you think is the most effective in boosting the China economy and also the consumer confidence?
I think the policy side, you need a couple of things. If you think about the problems right now, it's probably 2 or 3 things. One is the property market is going through a major correction. So in a way, you need to address the inventory overhang in the Chinese property sector. Number 2, after 2021, the tech sector crackdown, after the 2022 pandemic lockdown, I would say that a lot of both individuals and businesses, they are a little lost in terms of the policy consistency. So I think obviously spending money, throwing money at the economy, that's a start. But I think in terms of policy consistency, that's going to be absolutely critical in restoring that level of confidence. I think in terms of investing in China, Stephanie had a great chart just now. I'll actually push that a little bit more and said, if you need to be invested in China for that 2 weeks at the end of September, up to the National Day, in order to generate that outperformance. Otherwise, it wouldn't have happened. It's a combination of incredibly cheap valuation at the time, very light positioning, as Tom mentioned, and also the policy catalyst. So in China in 2025, it's almost like you have to wait for the similar conditions. Valuation is okay. It's still reasonable. Positioning is still light. The question then becomes, where is that policy catalyst going to come from? Is it around the MPC meeting? I would actually throw something out as a curveball. What if Trump and Xi gets on a lot better than people think? Now, that's not the core scenario for anybody, but what if they're willing to negotiate rather than go straight into a trade war? That, to me, could potentially be a positive catalyst. The other last point I want to bring up is, if you look back to 2023, 2024, where the market was doing really, really badly, actually there were some sectors that did well. Banks, energy companies, telecommunications, high dividend yield players. If you look at 30-year government bond in China today, yield level is actually lower than Japan. So I was in Shenzhen this afternoon doing our own in-house event, And we spent a lot of time telling Chinese clients what they should be doing in a low yield environment, not that different from the US, a few years ago. So I think, if the economy is not moving into a faster gear, you are going to see a lot of Chinese investors willing to invest in high yield stocks. A bit more defensive, state-owned companies, but they're still giving you 6-7% yields. That's not a bad deal for them. But if the economy starts to pick up to some extent, then your familiar names, tech names, consumer stocks, that might actually do a little better.
Anything to add on China market for Stephanie?
Sure. I was actually on Bloomberg and BBC this week, and all they asked about was about the renminbi. Given it is testing 7.3, which is a very, very important level in the past 3 years, actually renminbi versus US dollar have tested that level 3 times, and it didn't break. So everyone was asking, and also, of course, like the PBOC governor made a surprise kind of appearance in AFF in Hong Kong, trying to kind of calm the market. So everybody was asking, where's the renminbi going? And I think our view is that, of course, there's a lot of things that China can control, right? The policies that they can put out, but also there's a lot of things that they cannot control. And one of the things is, of course, if you think about the renminbi, the other side is US dollar. So in a very, very strong US dollar environment, actually, renminbi is very, very, tends to be quite weak, and that goes the same with other emerging market currencies and also markets as well. And I think given what we said about fiscal stimulus and also kind of the Trump policies, we would expect that, interest rates would stay higher for longer in the US. And that means that US dollar could actually remain quite strong. So I think that's kind of one big headwind, that it's kind of out of control for China. But I'm hopeful that in March we're going to see much more policies coming out. So again, StashAway uses data to determine our asset allocation. So if we do see a pickup in terms of fundamental activities, then I would be more than happy to see us going overweight China. But for now, we will market weight.
I see. Thank you. And now moves to my favorite part of this panel discussion. It's we will end this panel by quick questions. So each of you will answer my question in 1 sentence. Okay. Just 1 sentence, no more. 30 seconds only. Okay. So first question is, what do you think would be the biggest risk in 2025? Thomas?
The return of inflation in the US.
And Tai?
Political problems outside of the US, Canada, Germany, France, they're all coming into Trump's inauguration without a functioning government.
Is that 1 sentence or 2? I think it's, as I said in the slides, immigration policies is one of the biggest risks that we see.
I see. Second question. What do you think would be the biggest opportunity in 2025? Start with Stephanie.
AI. I think it's still the biggest opportunity. There will be, actually that's more than 1 sentence, sorry. But I think there is a very, very fertile ground for just kind of hunting for returns.
AI is too obvious. So I'm going to infrastructure and shipping. Because you have a more diversified supply chain around the world, you are going to need a lot more ships and a lot more ports to support that.
Last question. Oh, no. Yep.
I'm going to be a bit controversial, comma, still 1 sentence, and say Chinese equities.
Okay. Comma, good strategy. And last question. What is your top tip to individual investors like our customers? Start with Tai.
Disciplined. 1 word.
Stay invested. 2 words.
Ignore the noise, 3 words.
Wonderful, wonderful. And thank you so much for our panelists. And now we open the floor for Q&A. So if you can scan the QR code on top. Someone has already asked some question. And you can also upvote the questions and let us see which question is on the top of your mind. So we answer the top 3 questions. So I will give you maybe 30 seconds to type any questions that you want to and vote any questions that you think will be on top of all the audience's mind. Okay. You can vote as well, not necessarily typing. And now I see many questions are already on here. Okay, let's start. So the first question is from Des. What do you think will be the Black Swan event of 2025? Black Swan event. Any of you can take this question.
Well, a black swan event by definition is something that no one sees coming, so that's quite a difficult question.
That's exactly how I was going to start.
I think if bond yields in the US get back above 5%, I think that will be a very interesting situation as to what happens with US equities. So I think, yeah.
Again, I'm going to go left field here. Weather-related events that has a major impact on global supply chains. If you look back to the last few years, we've had a shipping sideways in the Suez Canal, not related to climate change, but we did have a number of events where power supply was disrupted. We've got a wildfire in LA right now. So I think a lot of that could actually have a major economic impact. And if you think about insurance companies that have to pay out, could that create or trigger some sort of a financial chain reaction down the line?
Stephanie, any add on that?
Yeah, I think if something similar to COVID happens again, I mean, to me that is unimaginable, but also, I mean, I think that would be the ultimate kind of black swan.
I see. Okay. Second question. Chinese equities has plunged in the past few weeks ahead of Trump's inauguration. Do you think Trump policy is still an overshadowing risk for the market? So in summary, is Trump's policy, how the implication of Trump's policy to the Chinese equity market?
Maybe I'll take it first.
Sure.
Yeah. I think definitely. There's of course a lot of concern about tariffs and how, because I mean Trump has floated numbers like 60%, but as we mentioned, we don't think actually that a lot of that will kind of materialize. So I think the market is partly over concerned. Also, I think it's a bit about the calendar as well, right? So we think about the Chinese New Year is actually coming earlier this year. So from now till perhaps like February, we don't actually expect major policies coming out from China. And given that there's this kind of policy vacuum until March, I think that triggers quite a bit of just kind of rotation outside of China. So I think most of that is actually quite temporary.
If you speak to any Chinese investors, they are very cautious over Trump. Although I do argue that they may be a little overreacting. If you look at MSCI China, about 88% of the revenue of MSCI China companies actually is generated domestically. So their direct exposure to export is relatively small. But at the same time, you have a very weak economy domestically. So if your export is not contributing, basically none of your engines firing in the right way. So I think in a sense, I would argue that the domestic policy is going to be much more important, as Stephanie already said, what happens after MPC or around fiscal policy, but definitely Trump's policy is influencing people's sentiment, even though it may not have that significant or rather the impact on the economy is sometimes overstated.
Just to add on those 2 points, which I agree with completely, is it does seem to me that like after 3 or 4 years of like a very anti-capitalist vibe from the regulators and the government in China, we've kind of switched to we are willing to support the market type of situation. And in that situation, actually similar to the Fed post-GFC, bad news is good news. So actually increased tariffs coming out of the US, combined with the fact that actually most of the Chinese economy is domestically driven, means more liquidity provisions, which is actually quite good for Chinese equities.
Great. Last question. What are the sectors that you are avoiding? Maybe this first goes to Tai.
Nothing in particular, but maybe the energy sector or commodities. Ultimately, we have, or especially in oil and gas, where we still have ample supply, also ample spare capacity. If there's any disruption in one market, someone else can come in and pick it up. And the fact that Trump's baby drill or Joe baby drill, it means that you're likely to see even more capacity being installed. So I think the oversupply in that market might be something to watch out for.
Thomas?
I know there's a lot of sectors, but I was going to say the same thing. But also just because of the fact that with the implementation of more tariffs, I do think that the global trade situation will start to deteriorate a little bit. And generally the highest beta for that trade is in global energy. So I think US energy looks relatively good, but I think global energy not so much.
I see. Stephanie?
Yeah, maybe I'll provide a different perspective. I mean, we were just looking at it for our next CIO Insight Outlook piece, which is going to come out in about 2 weeks' time. And I think one of the, using that framework, we basically look at sectors in terms of where surprises could be. And one area is the consumer sector. And that is, the reason for that is because, number one, it can actually be negatively impacted by high inflation in terms of labor, more controls on labor. And then secondly, I mean, it is one of the sectors that get disrupted most by AI. So that is perhaps a different perspective to share.
Okay, that's the top 3 questions that we will answer. If other question is not answered, no worry. You can reach out to your wealth or client advisor for those questions, and we'll try our best to answer any questions that you may have. Now, a huge thank you to our incredible panelists, Stephanie, Tai, and Thomas, for sharing their expertise and insights with us this evening. May I now invite all the speakers to come onto the stage for a group photo first.